GME down 21% here in after hours. This follows their earnings report, which was very strange. They did a couple things that are different, and we'll talk about that here in this video and kind of talk about what this means going ahead for GME as well as AMC. So I hope you guys are ready. Let's get into it. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. Events like this are, big reasons why sometimes hedging in both directions can be good, because although we were leaned towards a bullish reaction on GME earnings, we had downside protection as well. And that downside protection, looks a little bit better after the fact. If you guys want to come trade with me live in real time, link down below in the description of this video. But nonetheless, let's dive into exactly what GME earnings are. So if we just look at the overview of their earnings, net sales came in at $1.23 billion for the period, compared to $1.37 billion in the prior year's first quarter. So sales are dropping, and they dropped last quarter as well. But the difference in why GME rallied last quarter was the cost of the revenue, meaning that they just cut cost. That was much better, and that's what actually gave them a net profit, even though cost or the actual revenue number came in smaller on a year-over-year basis. Selling, general, and administrative expenses were $345.7 million, or 27.9% of net sales for the period, compared to $452.2 million, or 32.8% of net sales in the prior year's first quarter. So the cost of generating this revenue is down over $105 million in the quarter on a year-over-year basis. That is positive. But the net loss was $50.5 million for the period, compared to a net loss of $157.9 million for the prior year's first quarter. This is really good, right? Things are improving for GME. Their cost-cutting efforts are working. That about $100 million they saved, right, year over year from their SG&A expenses is going straight to the bottom line. It saved them about the same, about $100 million for their net loss, which is good, and things are improving, but markets wanted to see a net profit. This number right here, a net loss of $50.5 million, this number last quarter was positive $48 million. So this was a lot worse than last quarter in terms of profitability, but again, better, way better than what it was a year ago. Transition costs related to European restructuring efforts were $14.5 million for the period. For the second quarter, the company will continue to incur transition charges. Cash equivalents, and marketable securities were $1.31 billion at the close of the quarter. Long-term debt remains limited to one low-interest, unsecured term loans associated with the French government's response to COVID-19. So the cash position they have is sizable. It's fine. The only thing that's really causing the stock to fall is this net loss. So when you look at this net loss and what it is in EPS, it's a net loss of 17 cents per share on a basic loss per share metric. So last year was a loss of 52 cents per share. This year, 17 cents per share. Again, an improvement, but markets were expecting a loss per share of 12 cents. And on the really optimistic note, people were hoping for a positive EPS. Unfortunately, that did not happen. But something that's also very strange is GME, you can see it's down 19.61% right now. GME earnings actually did not come out right away. The stock popped about 10%. And then dropped about 10% and traded down about 5% for a while. And then earnings actually came out right here. Now, you've seen a couple weird things happen initially. Ryan Cohen is now elected as the executive chairman. His job his responsibilities include capital allocation and overseeing management. And that is what came out initially. And they also obviously fired the CEO. His name is Matt Furlong. So that really initially popped the stock and then dropped the stock, and then the earnings came. But I guess the strangest part about all of this is that GameStop actually canceled their earnings call. So there's not going to be an earnings call. So we're not going to get any clarification. We're not going to get any details about anything. And that's probably why the stock is down almost 20% right now. It's probably not just the numbers that are doing this. It's probably not this change up in management. A big part of it might be because there's no earnings call. And that's strange. AMC stock is down about 1.27%, seeing that sympathy move that we expected, but not falling nearly to the same extent as GME. Also, what we expected because AMC has already fallen so much recently. So AMC, including the move down in after hours of negative 0.85%, the stock is still positive about 1.1% on the day, whereas GME is not. So it looks like this catalyst probably not going to be a bullish catalyst after all. Although it did look like you were creeping into earnings very bullishly. So we'll have to see exactly how these things play out if we get any new headlines that come across. But there is no earnings call. At the same time, the markets, guys, the broad markets, fell a lot today, actually. The NASDAQ itself fell 1.70% to close out the day, down 0.09% still here in after hours. So continuing to fall. This comes after Citibank said that there's a red flag that maybe some profit taking will be starting to take place very soon. The average long position on the NASDAQ is up 7.6%. This is the highest since this model started more than 12 years ago. And this increases the chances of profit taking significantly. And you're kind of seeing that today on stocks like Nvidia going down, stocks like Meta. Some of your biggest runners of 2023 are the ones that are actually falling today. Whereas if you look at CNBC and you take a look at the index performances, the Russell 2000 was actually up almost 2%. And the NASDAQ was down 1.29%. At the same time as all of this, New York looks like a Desert Storm war city. I mean, absolutely insane what's going on in New York. This really has nothing to do with our financial markets, but I figured we'd just look at this real quick. Look at that. It is orange. It is orange due to the wildfires in Canada, which I live in Michigan, which is kind of strange. Sometimes you could see it a little bit here, but not nearly to that extreme. If you guys live in New York, just stay the F inside. That definitely can't be good for your lungs. But nonetheless, guys, if we take a look at the Ortex data and some of the other things that you need to know about today, the biggest thing that is really affecting the markets is what Canada did. Canada paused their interest rate hikes at 4.5% for the last 3 meetings now. Well, what they did today was actually come out and they raised rates. They unexpectedly raised rates. 80% of Bloomberg economists did not expect this to happen. And this is kind of what the markets are pricing in for America. You're expecting a pause at the June meeting. Markets are pricing in a rate hike in July. But what's actually happening right here is the probability of rate cuts in 2023 are really going away. Now you're expecting one rate cut this year, and that rate cut looks more priced in than not November 1st of 2023. Considering if the Fed does raise rates to 5.25% to 5.5%, Markets are expecting November 1st rates to be in between 5 and 5.25%. That would be a rate hike if the Fed does raise in July. And for December, you're expecting still just one rate hike or rate cut for this year. January 2024 is when you start to price in another rate cut, taking rates to 4.75 to 5%. But you're no longer pricing in 3 or 4 rate cuts by the end of this year. You're only pricing in one. And that's why some of your big tech names as well are falling, because these valuations are unsustainable unless you get several Fed rate cuts by the end of this year. So I think this is actually a pretty big deal for our markets and specifically for technology. And we'll see what happens from here. If you look at June 14th, the next Fed meeting for us, our Fed Jerome Powell, there's a 70.2% chance of the Fed pausing in June. And in July, there is a 51% chance of a rate hike, which is very strange. Typically, when the Fed pauses, they don't tend to raise rates the next meeting after that. That's not really how things usually work. So things are going to be super volatile in the Fed funds market here, trying to predict what the Fed's going to do. It wouldn't surprise me if the Fed raises rates this meeting and then pauses in July, and markets are flip-flop right now, expecting the complete opposite. So I do expect a lot of volatility from this situation. As you guys do know, if you are invested in stocks like AMC or even GME for that matter that are heavily shorted, then you know if big tech comes down, well, that's kind of what you need to see to squeeze some collateral, to kind of take some money out of hedge funds' pockets, to put pressure on them to actually cover on some of these short positions. If we take a look at the option activity here today with AMC Stock, you have seen 5 orders totaling $560,000 with a positive order value of 0%. And I don't even think these numbers are right, because if you look down here, you've seen a July 21st $10 put alone worth $3.06 million. They're trying to suppress AMC, and also by shorting AMC, they're buying those deep in the money puts, which forces market makers to go out and short stock of AMC. Now, if we take a look at the live short interest off free float, that is sitting at 21.89%, 113.02 million shares currently sold short, cost to borrow average of 80.88%, cost to borrow max of 269.5%, cost to borrow minimum of 50%. Interactive Brokers has a cost to borrow fee of 64.3%, with about 90,000 shares that are currently available to be lent out. So as far as where we go from here with AMC, I mean, GME is not going to have a positive effect on the name. As you can see, stock's down 1% after hours. But I don't think it has to start another longer term downtrend, at least with AMC. You've already been in a downtrend. So, even the technical indicator that we got yesterday is showing the stock could rally to over $6.50 per share, with low end support at $4.50 per share. So you really want to watch the key technical levels here. $4.50 per share being one to that downside that is pretty close to where you are right now. Stock's at $4.67 per share. That would be a drop of about 17 cents from here. If you do break under that, you could see more downside. But as this continuation wedge is showing, you could approach as high as $6.40 per share over the next couple of weeks, guys. The RSI finally bouncing off of the oversold level at 33, sitting at 42.5, and the MACD has been bearish, but starting to curl up and look a little bit more positive. So that is what I have for you guys here in this video. There's really no other upcoming catalyst or anything that's really going to move this market from here. So there's really nothing. There's really nothing happening in the markets. This is a really slow week before we get into next week, where we actually have the Fed meeting, guys. That is going to be it for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. If you guys do want to come trade with me live in real time, link down below in the description of this video as well. You guys have a great rest of your day, and I will see you in the next one.